How's it going, buddy? Hope you're having a good time. In this video, I'm going to give you an introduction to the world of trading. We are going to talk about some basics that you should know before putting your head into the study of our strategies. Okay, so let me give you a quick overview of the topics that we will discuss in this section. What questions are we going to answer in this video? First of all, what is the market? What is a market? And what kind of financial markets are interesting for us to trade? And how and why does the price move up or down in Forex or indices? And why should you trade Forex or indices? What are the benefits of trading? And why does the exchange rate, the price changes all the time? And what are the big players in the Forex market? And what are their interests? And how does the market work? How does price move in terms of free market theory? And is the Forex market or indices market manipulated? Well, you're going to find out in this video, okay? So let's start. What is a market? A market is simply a platform where buyers and sellers come together to exchange, for example, goods, services, or financial instruments. And we are going to focus on financial instruments, of course. So next thing, what kind of different financial markets are interesting for us to trade? And yeah, there are several financial markets that are popular among traders, including, first of all, the Forex market, the foreign exchange market. This is the largest and most liquid financial market in the world, offering a wide range of currency pairs to trade. And the Forex markets are open 24 hours a day, 5 days a week, providing countless opportunities for us traders to participate in, okay? The next market are stocks. The stock markets, such as the New York Stock Exchange and NASDAQ, they offer a wide range of individual stocks to trade, including those of large companies and small startups. And stocks are influenced by a variety of factors such as company news, earnings reports, and market sentiment, providing day traders with numerous trading opportunities. The next markets are indices, index markets. Indices such as the S&P 500, NASDAQ, and the Dow Jones, they represent a basket of stocks and provide a broad-based view of the stock market, okay? Indices are often used by day traders as a way to gain exposure to the stock market as a whole, okay? And the next market is the futures market, and futures markets allow traders to speculate on the price of commodities such as oil, gold, and agricultural products, as well as financial instruments such as stock indices and bonds. And yeah, futures markets are open for a limited period each day and making them well suited for day trading as well. And then we have cryptocurrencies, the crypto market, okay? Cryptocurrency markets such as Bitcoin, Ethereum, they offer a highly volatile asset that can provide significant trading opportunities for day traders. Cryptocurrency markets are open 24/7, making them well suited for traders looking for round-the-clock trading opportunities. And we are going to focus on the Forex trading and indices trading in this course, okay? And the next thing we want to know is how and why does the price move up or down in Forex trading? Well, in Forex trading, the price of a currency pair moves up or down based on market supply and demand for the two currencies that make up the pair, okay? The price of a currency pair such as euro, US dollar, is determined by the relative value of one currency compared to the other. So the exchange rate between the two currencies fluctuates based on changes in supply and demand for each currency. And the primary factors that drive demand for a currency are the economic and political conditions in the country whose currency is being traded. For example, if a country has a strong economy with low unemployment and stable political conditions, the demand for its currency is likely to be high, leading to an appreciation in its exchange rate. On the other hand, if a country has a weak economy with high unemployment and political instability, the demand for its currency is likely to be low, leading to depreciation in its exchange rate. In addition to these fundamental factors, speculation, market sentiment, and global events can also impact the supply and demand for a currency and its exchange rate. For example, a major geopolitical event or a natural disaster could lead to a sudden shift in market sentiment, causing a rapid and significant change in the exchange rate, the price, okay? And we as traders, we seek to profit from these changes in exchange rates by buying and selling currencies. So the next thing we want to know is how and why does the price move up or down in indices trading, in index trading? Well, the price of indices such as the S&P 500, Nasdaq or Dow Jones moves up or down based on changes in the value of the individual stocks that make up the index. In general, the price of an index is influenced by several factors, including, first of all, economic data. Economic data, such as employment reports and GDP numbers, can have a significant impact on the stock market and, in turn, the price of indices. Positive economic data can boost investors' confidence and increase demand for stocks, pushing the price of indices higher. Conversely, negative economic data can dampen investor confidence and decrease demand for stocks, causing the price of indices to fall. And the next thing is company news. Company news, such as earnings report, mergers, and acquisitions, can also impact the stock market and the price of indices. And positive company news, of course, can boost the value of individual stocks and push the price of indices higher, while negative company news can lead to decreased demand for individual stocks and a lower price for indices, logically. Next thing we have is market sentiment. The market sentiment, or the general mood of the market, can also impact the price of indices. When market sentiment is positive, investors tend to be more optimistic and demand for stocks is higher, pushing the price of indices higher, of course. And conversely, when market sentiment is negative, the demand for stocks decreases and the price of indices falls. In conclusion, the price of indices is influenced by a combination of factors including economic data, company news, and market sentiment. These factors can cause the price of indices to move up or down in response to changes in supply and demand for the individual stocks that make up the index, okay? So the next thing we want to talk about is why should you trade Forex or indices? What are the benefits, okay? And yeah, trading Forex or indices can offer several benefits, including, first of all, liquidity. The Forex market is the largest and most liquid financial market in the world, with an average daily trading volume of over $6 trillion, okay? And this means that you can easily enter and exit positions and access large amounts of capital when necessary. The next thing is market accessibility. The Forex market is open 24 hours a day, 5 days a week, allowing traders greater flexibility to trade when it suits them. The next thing that is beneficial is leverage. Forex and index trading often offer high leverage, which allows traders to control large positions with a small amount of capital. And however, it's important to use leverage responsibly and understand the risks involved, okay? The next beautiful thing about trading is volatility. Forex and index markets can experience significant price swings, providing opportunities for traders to profit from price movements in both directions, okay? Up and down. We make money in both directions. And the next beautiful thing about trading is compound interest. If you are able to consistently make a profit of 10% per month or more with your trading strategy, and you use straight risk management by risking 1% of your account balance on each trade, then your account will grow over time as a result of compound interest. As you make profits and add them to your account balance, the amount of capital available for trading will increase, allowing you to make larger trades and potentially earn more profits. And this in turn will increase the overall size of your account, which will compound your returns even further. And the next beautiful thing about trading is prop trading with funding capital. The trader is trading with the firm's money. They have greater flexibility in terms of the types of trades they can take, as they are not limited by their own personal capital. And this can give you the shortcut to financial independence as a skilled trader, which is the ultimate goal of this training program. And the next thing we want to talk about is what are the big players in the Forex market and what are their interests? Well, the Forex market is a decentralized market, meaning that there is no single exchange where all currency trading takes place, okay? Despite this, there are several big players that participate in the Forex market and influence its movements. Some of the main players in the Forex markets are, first of all, the central banks. Central banks such as the Federal Reserve in the US, the European Central Bank, and the Bank of Japan play a significant role in the Forex market, as they have the power to control interest rates and money supply, which can impact the value of their currency. Then we have commercial banks. And commercial banks, such as Citibank and HSBC, participate in the Forex market as they need to convert currencies for their clients and, of course, to manage their own currency exposure. The next big player are hedge funds and investment banks. Hedge funds and investment banks, such as Goldman Sachs, JP Morgan, they participate in the Forex market to take advantage of price movements and to make a profit. And these institutions often use sophisticated trading strategies and have large amounts of capital, allowing them to move markets. And then we have retail Forex traders. Retail Forex traders, just like me, are individual traders who participate in the Forex market for personal investment or speculative purposes. They often trade through online brokers and have smaller amounts of capital compared to institutional traders. And yeah, the interest of these big players in the Forex market vary. Central banks, they aim to maintain stability in the value of their currency and achieve their monetary policy goals, while commercial banks aim to provide currency conversion services for their clients and to manage their own currency risk, right? Hedge funds and investment banks aim to make a profit through currency trading, while retail Forex traders also aim to make a profit through currency trading. So the next thing we want to talk about is how does the market work? How does price move in terms of free market theory? In terms of free market theory, the Forex market and indices market work through the laws of supply and demand. The price of a currency or index is determined by the forces of supply and demand in the market. In the Forex market, the exchange rate between two currencies is determined by the demand for one currency relative to the supply of the other currency. In both Forex and indices markets, the laws of supply and demands are influenced by a variety of factors, including economic data, company news, and market sentiment. Market participants, including individual investors, institutional investors, and central banks, are constantly buying and selling currencies and stocks, and their actions impact the supply and demand in the markets, driving the price of Forex and indices higher or lower. So in the free market, prices are determined by the market participants who act on their own self-interest to buy low and sell high. The market is self-correcting and prices will adjust to reflect changes in supply and demand over time. In this way, Forex and indices prices in free markets are driven by market forces and are not controlled by a central authority. But that doesn't mean that the big players do not manipulate the markets with their large volumes for their interests. So the next thing we want to talk about is the Forex market or indices market manipulated? The Forex market and indices market, like any financial market, is subject to various forms of manipulation. Some common forms of manipulation in these markets are market manipulations and price manipulations. So what is market manipulation? Well, market manipulation is when a large market participant, such as a large bank or hedge fund, uses its market power to manipulate the price of a currency. And this can be done through buying or selling large amounts of a currency, and thereby affecting the supply and demand balance and pushing the price in the desired direction. The next thing is price manipulation. This is when a market participant artificially inflates or deflates the price of a currency through deceptive or fraudulent practices. For example, a market participant might engage in spoofing, which is when they place large orders with the intention of canceling them before they are executed to create the illusion of demand and influence the price. For us as retail traders, it is essential to understand who got the most influence in price movements and, more importantly, how they manipulate the price to get their big positions into the market. If these big players want to build up large buy positions, they first need to accumulate sell orders on the other side to create enough liquidity to fill their buy orders without moving the price too fast. Okay? If they would just throw the buy orders in, they would not be able to get the price they want, and the market would move way too fast. If you understand how those manipulations look like, and if you know when they happen, then you got an edge that you can use to print endless amounts of money. And this is what you will learn in this training program, step by step. Especially the X-ray strategy is completely based on market maker manipulations, which will change the game for you. So please take notes along the way to help you understand and manifest this knowledge, okay? I will try to explain it as easy as possible for you to understand it without bullshitting around. And this training program is straight to the point and easy to understand. And that's why it's called the Genius Trading Masterclass. Please take your time with this course. Don't rush. You're not in a hurry. Okay? This skill set will benefit you for the rest of your life and give you financial independence and time freedom to do whatever the fuck you want every day. Thank you for your time. I'll see you in the next chapter.